Good afternoon and welcome to the QCA Webinar with the Takeover Panel. Throughout this recorded meeting, attendees will be in listen-only mode. Questions can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your question and press send. I'd now like to hand you over to James Ashton, CEO of the QCA. Good afternoon.
Good afternoon, Paul. Thank you very much. Welcome, everybody. We're very pleased to have a significant number of advisors and companies on this call. This is the latest in the series of webinars that we've done at the QCA this year. If you want to catch up on previous webinars on previous topics, they're all on YouTube. And in the last few weeks and months, we've covered subjects including equality and diversity in the boardroom, how to get the best out of boardroom performance reviews, and the trend that a number of members and people have talked to this year, the trend for companies to go from AIM to the main market. My only other plug today would be, I get asked quite a lot, what does the QCA do? If you want to take a look and find out about that, we published our annual review last week. That gives the details of the whole 12 months of work up to June last year, and details in there of the 50 events that we put on, the 20 policy submissions, and also the 5 research reports that went into Westminster and into the media. So today, the conversation is about the Takeover Panel. The QCA is proud to be an appointing body for the Takeover Panel, and we have a good close relationship with them. And it's very helpful for Charlie Crochet, the Deputy Director General of the Takeover Panel, to spend a bit of time with members, talk about the principles, how the organisation works, and how we should be relating to it. So, Charlie, welcome, and let me hand over to you. I would say as we hand over, we want lots of questions for this session. Ping them in as we go, and I'll make sure that we get through them once Charlie's gone through the presentation. Thank you.
Thank you, James, and thank you to everyone who's joined and for devoting time to hear about the Takeover Panel. So this is a presentation that is primarily targeted at directors of companies, particularly directors of target companies, but I know there are a number of advisors on as well, so I hope that will be of interest to you. But I'm pitching it at a level which is focused on directors who may not be entirely familiar with the Takeover Panel, what it does, and also what it doesn't do. And so that's how I'm setting this up. Just by way of introduction, we're going to cover what the Takeover Panel is, what it does, and that is, of course, administering the Takeover Code, which is our rule book. We'll look at some of the key principles and rules that are set out in the Takeover Code. Also covering just how we do our business. We're a bit unusual in that regard. We actively encourage people to speak to us if they're ever in any doubt about the application of the rules, and that's different to a number of other regulators. We actively encourage consultation, and there's just some key do's and don'ts about how directors might interact with us. So let's start at the beginning. Who or what is the Takeover Panel? I colloquially describe our job as the regulatory authority whose responsibility it is to regulate the passing of corporate control. Believe it or not, this is a job that the panel has done since 1968. So we have been around a long time. We have regulated a large number of takeovers. But one of the interesting things about this job and about this role is that new things crop up all the time. So I've been here for far too long, but let's say 25 years. And one of the things I find fascinating about the job is how new practices develop, and the code keeps evolving, and we try our very best to keep up with market practices and practitioners and what's going on in the market. Put simply, we regulate the passing of corporate control of companies that are publicly traded, whether that's on the main list of the stock exchange or on AIM. And also, it's important that we regulate only companies which are registered in the UK, the Channel Islands, or the Isle of Man. That is because the UK Takeover Code is basically founded on UK company law, and that's why we have to limit our jurisdiction to companies that are registered in the UK, the Channel Islands, or the Isle of Man, and if they are publicly traded on one of the markets that I've identified. You might think this is an odd place to start, but I just want to cover what we don't do, and that is we're not here to set for example, the price at which a takeover must be made. That is for the offeror, the bidder, the acquirer to determine, and for shareholders to decide if they want to accept it. It is absolutely not our role. We are not valuation experts. We don't know the precise price at which control should be said to pass in relation to a particular company. We let shareholders decide that. It's very important that shareholders are the owners of the company, and they should decide whether they wish a particular takeover to go through or not. We also don't do competition issues. There is a very competent regulator in the form of the CMA that deals with antitrust and competition issues, and that is absolutely not a matter for us. And we also don't do what you might call public interest or national security issues. Those are obviously matters for government and not matters for the panel. But we are an independent regulator whose responsibility is to provide a framework for the regulating of control of a company. And in so doing, we want to ensure that shareholders in the company are able to make a fair and transparent decision about whether they wish to accept an offer, and they all get treated equally. One of the reasons why the panel was set up so many years ago was because, quite frankly, it was a bit of the Wild West. Big shareholders were getting favourable treatment by comparison to small shareholders in connection with an offer. They were getting preferential deals, they were getting preferential information, and it was decided that that was not the way in which takeovers should be conducted, and that takeovers should be conducted where all shareholders are treated equally. And that is a fundamental principle that we seek to uphold and observe. We regulate transactions on a real-time basis. There is obviously, if we're regulating, as I've just said, takeovers of listed companies, then there is a market that is trading actively while the takeover is taking place. It might lead to an increased level of activity in the company's shares, and therefore we want to make sure that there is transparency in that market. That goes to the statements that are made, whether they're accurate, people can rely on them, make informed decisions in relation to those statements. And we also have, I think, amongst the most sophisticated rules about the disclosure of ownership of companies and also trades that are taking place in the market, because obviously that goes to the market price. And finally, an overriding principle is to ensure that there is an orderly framework for the conduct of offers. And that goes to, for example, the timetable and other such matters. Now, I said earlier, we're an independent regulator. We are independent of government. Obviously, we sit under the responsibility of the Department for Business. But when I say we're independent, I mean by that the panel appoints its own members, and it appoints people who are interested in and affected by takeovers in one way or another. So that's practitioners, members of industry, and also shareholders, being the people who own the companies. So we are self-appointing, and also we are self-funding, and we raise our money through document fees that are paid by reference to the value of an offer, and also by reference to something called the Panel on Takeovers and Mergers Levy, which is a trade that is paid on all transactions of £1.50 on any transaction of £10,000 or more. So that enables us to be independent, and therefore, if there is a lively debate about how a particular takeover is being transacted, the people on the other side of the table who may be getting cross with us can be self-assured that the regulator is independent and is not a mouthpiece for government. We are giving rulings on the application of the Takeover Code because we think that is the right way for the transaction to be regulated. I work for an organisation called the Executive, which is the organisation that deals with things on a day-to-day basis. And one of the great strengths of the Executive is that it is staffed by a blend of rather boring permanent staff like me, who do it for a great many years, but more importantly, secondees who come from investment banks and law firms on 2-year secondments. They work for us while they are here, and the organisation is headed by a Director General who comes on a 2-year secondment from one of the large investment banks. And I think that is a great strength of the organisation and why it's managed to continue to operate for as long as it has. Now, the Takeover Code is founded on 6 general principles and is underpinned by then a number of rules, a number of notes on rules, and practice statements. One thing that's changed a lot in the time that I've been here is the length of the rule book. This is the rule book now. It was probably about half the length when I first joined. I'm afraid the way of the world is that it's important to write things down now and explain what our practice is in particular areas, and therefore the rule book has inevitably got longer. It's not something that I would necessarily wish it were that way, but it means that our policies and our practices are now very clear. They're spelled out. It does inevitably mean that one is the matters are a bit more rigid than they were, say, 25 years ago. But also an important point to note is that I think that every single rule of the Takeover Code, one way or another, can be traced back to the general principles that underpin everything we do. There are 6 of them. They are derived from the European Takeover Directive that was implemented in 2006. Just as by way of background, the Takeover Directive was actually based upon the Takeover Code. So the implementation of the Takeover Directive, when it happened in 2006, was not actually a seismic event for the Takeover Panel because, as I say, the directive was based on the code. And the flip side of that, of course, when Brexit happened more recently, then again, things were able to carry on very much as before. We're still applying the Takeover Code in very much the same form as it's been for a great many years, although, as I stress, it has got longer. Let's just spend a minute looking at these general principles. They are, I hope, statements of the bleeding obvious, but they are nonetheless hugely, hugely important, and it's important that people are aware of them. General Principle 1, I've highlighted already. That is that all shareholders in the target company should receive equal treatment, and there shouldn't be any notion of special deals with a large shareholder because that shareholder carries more votes than a small shareholder. Everyone should be treated equally. I'm sure anyone who's ever been working for a company that has been on the receiving end of a takeover will testify to the fact that a takeover is a very, very, very important moment or time in a company's life. And therefore, it is very important that shareholders, when they're deciding whether to accept it, have sufficient time to make that important decision and have the right information to make that important decision. And therefore, it won't surprise you that there are rules that cover not only the time at which information must be provided, but also the matters that must be covered in the documentation that must be sent to shareholders. And of course, these days, of course, much of the information is actually provided by way of public announcements. Those go out via Regulatory Information Service, and all information published in connection with an offer is then required to be published on the relevant company's website so that everyone can go to a single reference point to find any information that they think is relevant to them in making their acceptance decision. General Principle 3 is something that the Takeover Panel has cared passionately about really from the very start, and that is that shareholders should decide the outcome of an offer, not the company's management, who may, and this is probably a feature that happened longer ago than does more than now, but the management taking action that may be in their own self-interest. But the key point is that we say that once a company is in receipt of an offer, shareholders should decide whether it succeeds or fails, and management should not be able to take action which frustrates that offer from proceeding. It's shareholders who should decide it. I've covered General Principle 4, I think, already. We want there to be fair and transparent markets in the shares of companies that are subject to a takeover. And that goes to the accuracy of the information provided, the sufficiency of the information that's provided, and also details of who the owners of the company's shares are, if they're trading, the details of those trades, so that people can see why a company's shares may be moving in a particular direction. General Principle 5 covers the very important point that if you're making a cash offer, you are expected to have that cash available to pay target company shareholders if in the event that the offer succeeds. It would be very bad for everyone concerned if a bidder were to make a cash offer for a company, the cash was turned out then not to be available. So there is a requirement, and it's a very, very important requirement, that anyone who is making a cash offer has to have a financial advisor give confirmation that the advisor thinks that the cash will be available if and when the offer succeeds. And finally, General Principle 6 says that target companies must not be put under excessive siege. As I've said earlier, anyone who's been on the wrong end of a takeover working for a company that's being bid for will testify that all the management and indeed senior employees' time will be devoted potentially to dealing with that takeover. And then during that period, the company is not focusing on its day job as much as it would necessarily like to. So it must be right that the takeover cannot go on ad infinitum. There must be a period where there has to be a decision taken as to whether the takeover will succeed or not. And the Takeover Code, not surprisingly, provides rules that govern that. And I'm going to come on to what those are in a minute. So let's just repeat. There are 6 general principles. These are funder basic to everything that we do. And one way or another, I would hope that all rules of the Takeover Code can be tracked back to them. I would stress that a number of people who've worked in this office, sometimes they don't necessarily know their way around all the rules and what Rule 16.2 says or what have you. But if you have a good feel for these general principles, you will be able to have an understanding and an intuition as to whether the panel is likely to agree to something or not, because these govern everything that we do. Moving on to the question of working with the Takeover Panel, I don't think any of this would come as any surprise, but it is just worth making the point. And on the left-hand side, our objectives, it won't surprise you that we are keen to make sure that our rule book is adhered to and that the rules and principles are complied with. I should stress we try and operate by consensus. Now, that doesn't mean that everyone is going to agree with us all the time, but we do try and make sure that people understand why we're giving a particular ruling and what the basis for it is and why the particular rule is being applied in the way in which it is. I should say virtually every single rule of the Takeover Code begins with the words "except with the consent of the panel," so it can be dispensed with in the event that it would operate in an unduly burdensome or inappropriate manner. In deciding whether to give a dispensation, we would always track back to the general principles and the basis of the rule to consider whether that's appropriate. But obviously, we want to make sure our rule is complied with, and if we're giving a dispensation, that there is a good reason for doing so. I've mentioned earlier that we're a real-time regulator. We're like a sort of referee in a football match. We're giving decisions on a real-time basis because the company's shares are being traded, and therefore it's important that we give decisions swiftly. These days, well, we do all our business over the telephone. We encourage people to speak to us if they have any questions. We do inevitably ask for written submissions, probably more than we used to when I first joined. That's just a function of wanting to make sure that there's no misunderstanding as to precisely the question we're being asked, why we're being asked the question, and what information is relevant to us determining that particular question. But we do try and give quick decisions, and we do that over the telephone, and we take calls at funny hours of day or night if that is necessary in order to resolve a matter in an expeditious manner. Obviously, takeovers are price sensitive transactions, and therefore it's very important that they are confidentiality of a takeover is maintained. One of the things that drives me completely bonkers is leaking. We have rules that require announcements if we think there's been a leak of a transaction, and we'll come on to those. But it does frustrate me enormously the way that leaks take place. But I would hope and pray that everything that comes into this office is the confidentiality of that information is maintained, because otherwise we can't encourage, we're going to not succeed in our objective in encouraging people to consult with us if they have any doubt about how a rule should be applied. The organization works because advisors are encouraged to consult with us, and that is advisors, I mean both bankers and lawyers, and they are encouraged to consult with us if they have any doubt about how the rules will be applied. We will always try and listen to all the arguments before reaching a determination, and also reaching a determination having heard the views of all relevant parties. Now, it may be that the particular matter necessitates us giving a ruling having only heard one side of the argument, because obviously the matter in question, if we were to want to speak to the other side, that would disclose a particular tactic ahead of it happening. In those cases, we would give what we call an ex parte ruling, which could be reversed in the event that the other side then raised issues that were thought to be pertinent and hadn't been raised with us in the first instance. I would hope that would be rare, but the point I'm trying to make is we do try and listen to all relevant parties' views before reaching a determination or whether to give a dispensation. I always put this slide in at this point because I would hate for anyone to think that we spend less time on small bids than we do on big bids. That is completely wrong. In fact, a very large proportion of what we do relates to takeovers of what you might call smaller companies, and obviously there'll be differing views as to where the line should be drawn on that. But I've said on the slide there, in the last 2 years, we run at about 60 or 70 bids a year. And a large proportion of those, 30-odd%, relate to transactions with a market value of 50 million or less. And indeed, over half have a market value of 250 million or less. So we are dealing day to day with bids for smaller companies. And I should say often these raise the most challenging and interesting issues. So we devote, equal amounts of time, indeed whatever time is necessary, to resolving any particular issue that is put before us. And whether it's a big bid or a small bid, we will still give it the full attention that it deserves. And indeed, as I say, bids for smaller companies tend to be often the things we're dealing with most. I think it's probably not a generalization to say that small companies tend to be bid for than doing the bidding. That's just an inevitable fact of size. So we often see, more often than not, we see smaller companies being target companies as opposed to bidding companies. But that's not sort of neither here nor there. But I do stress that whenever a company is bid for, it's important that it engages appropriate advisors who will be able to advise the company on the do's and don'ts and how to behave and when the panel should be consulted, etc., etc. That's probably, I'm going to come to it at the very end, that's probably, if you remember one thing from what I say today, that's the most important thing. We actively encourage people to consult with us. I think an important point I always like to draw out to people is the difference between what is called a possible offer announcement and a firm offer announcement. And the clue is kind of in the name, but it is worth just drawing out a couple of key distinctions. A possible offer announcement is where someone says, I am thinking of making an offer for target company X. And it may also say, and these are the terms on which I'm thinking of making an offer for company X. It's a so-called virtual bid. There is no obligation on the relevant person to actually make an offer. It's just saying it's thinking of making an offer. If that person discloses indicative offer terms, then any offer that it makes would have to be at least on those terms. There are rules that require that. And going back to the anti-siege general principle 6 I talked about earlier, there is a colloquially known provision called the put up or shut up deadline, or PUZU as it's sometimes known. And what that requires is that a so-called potential offeror, a named potential offeror, right? It's in the public domain. A named potential offeror must, within 28 days of itself being publicly identified, clarify its position as to whether it's for real or whether it's not for real. And the way that's done is by, if you're for real, you have to announce a so-called firm intention to make an offer, which I'm going to explain in a second, or you announce that you're not going to make an offer. And there is a well-known rule of the Takeover Code, Rule 2.8, that says that if someone says they are not going to make an offer or have no intention of making an offer, they are effectively offside from doing so for a period of 6 months, except if certain circumstances arise as disclosed at the time of the offer announcement. So the wonderful PUZU deadline imposes a date by which the potential offeror who's causing disruption for the target company has to clarify its position as to whether it's going to make an offer or not. Now, that deadline, it won't surprise you, can be extended. We can give our consent to that, but we will only do that if the target company agrees. So it's not, remember, the rule is founded on the anti-siege general principle. Well, if the target company is happy to continue to have discussions beyond the 28-day period, then who are we to interfere with that? We would ask that there be an announcement made by the target company explaining that discussions continue and that the deadline's been extended. But we wouldn't tend to say we know better than the target company, because of course we don't. Compare and contrast a possible offer announcement with a so-called announcement of a firm intention to make an offer. That is where a bidder says, right, here I am, I confirm to the world I am announcing an offer on these terms. And if you do that, you then start the so-called offer timetable. There is an obligation on the offeror to proceed with its offer, to make an offer on the terms that it announces. It can only walk away from that offer in the event that it can legitimately invoke a condition to the offer. And it has to explain, not surprisingly, in a so-called firm offer announcement, and then subsequently in an offer document, what its plans for the business are. And that is, it then sets out its stall, so to speak, and then shareholders can decide if they wish to accept it within the offer timetable. Now, you've probably gathered this point already. I mean, a great number of things have changed in the 25 or so years that I've been here. Once upon a time, all takeovers were implemented by way of a contractual offer, applying good old contract law, where the offeror makes an offer and the target company shareholders decide if they wish to accept it. There are many, if not, most, what are known as recommended offers, i.e. where the target company board is saying to its shareholders, you should accept this offer. The vast majority of recommended offers are now implemented by a procedure known as a scheme of arrangement. A scheme of arrangement was once described to me as being something like Listerine, and you may think, what on earth are you talking about now? The point I'm making is that apparently Listerine, when it was first invented, was designed to clean floors, and then someone decided that it would be a good idea, it would be better put to use to enable people to clean their teeth. Well, schemes of arrangement were originally invented as a process in the Companies Act to enable a company to come up with some sort of arrangement with its shareholders. And the way it's implemented is if 3/4 by value of the shareholders voting on a particular transaction approve it, then it binds the whole company. Well, clever lawyers some 10 or 15 years ago came up with the idea that a recommended offer could best be implemented by way of a scheme of arrangement, because that would then ensure that 100% of the company could be acquired in the event that it was approved by the requisite majority. In the early days, there were also stamp duty savings as well, but those no longer apply. Anyway, my point is that these days, most recommended offers are implemented by way of a scheme of arrangement, and that's just a development. The code now has provisions relating to how that can take place, moving with the times. A really, really, really important point for directors to understand. Whenever I speak to a director of a company who's not necessarily familiar with what I do, I say a key point you need to be aware of is if you get what's called an approach, you need to call up your advisors and tell them about it. Why is that? Because if you get an approach, a whole lot of obligations start to apply under the Takeover Code. Let's understand, first of all, what is an approach. An approach is where someone contacts you as a director and says, I think I'd like to buy your company. It doesn't have to be in writing. It doesn't have to have indicative offer terms. It just says that it's someone registering interest with you about their interest in acquiring a company. In the event that that happens, then as a target company, look at the third bullet point down there, you take on obligations to make an announcement in the event that certain trigger events happen. And they are that there is rumor and speculation regarding the possible offer for the company or an untoward movement in the company's share price. And to enable the panel to decide whether, and because we are, I'm afraid, those nasty people who require announcements to be made, which says company X has received an approach that may or may not lead to an offer from company Y. We're the people who require that announcement. In order for us to be able to make a determination as to whether that obligation is triggered, we need to be consulted and we need to be notified if there is any rumor and speculation regarding the company, or if there is a price movement beyond certain limits, being 5% in a particular day or 10% from the time when the approach is first received. Now, the reason I emphasize this point is that occasionally directors may be having meetings with people, an approach is made, but they may not appreciate the importance of it under the Takeover Code. So that's why I'm emphasizing now, if someone says to you, I am thinking of making an offer for your company, or you receive a letter to that effect, that constitutes an approach. Then you need to speak to your advisors, because they can then take on the obligation to consult the panel and to make an announcement if that is necessary. And that announcement might just say, along the lines of what I've just said, that the company's received an approach that may or may not lead to an offer, and you have to name who the target, who the bidding company is. That bidder will get the 28-day put up or shut up deadline that I've referred to earlier, and so the whole merry dance begins. But it's important to understand what an approach is and when it's received. And as I'm going to come on to in a short while, there is a separate rule relating to anti-frustrating action. I mentioned it in connection with General Principle 3 earlier, and that applies from the time when an approach is received. So it's super important to understand when that gun has gone off. If you're on the bidding side, these obligations kick in when you start to what's known as first actively consider an offer. Now that is, I appreciate, a difficult judgment. It's when particularly if you're, say, a private equity house where you might be considering acquisitions all the time. There are certain factors that we have called out in a relevant practice statement that help us decide that, namely whether you're approaching external parties, whether you've been to your board or your investment committee, and whether you've appointed advisors. Each case will have to be determined on its facts, but when a bidder starts to first actively consider an offer, then that bidder takes on obligations to consult the panel in the event that there may be a need for an announcement to be made. The final point I've just made on this slide is to repeat a point I've said many times, which is a company in receipt of an offer must appoint an advisor, and that advisor has two jobs. One is when the offer is made, to advise the board on whether the financial terms of the offer are fair and reasonable or not, and then that advice must be communicated to the company's shareholders to help them in their decision whether to accept the offer. But separately, the so-called Rule 3 advisor has a job in liaising with the panel about how the rules are applied. We take the Rule 3 advisor's opinion very seriously in deciding how to apply our rules during the context of an offer and whether to grant a dispensation, for example. Now, when a so-called offer period commences, because an announcement has been made of a possible or indeed a firm offer for a company, that will commence what we call an offer period. Companies in an offer period then appear on the Takeover Panel's disclosure table. That's published on our website, and that lists all the companies that are publicly subject to an offer at that time. There may be other companies that are in talks, and as long as those talks are proceeding on a confidential basis, then there's no need for that to be made public. But where an offer is a matter of public record, the company in question is on our disclosure table, and a whole lot of rules kick in. It won't surprise you. Rule 19, we want, as I've said this already, information that is published into the market to be accurate and fulsome, and giving all shareholders all the information they need to decide whether to accept an offer. There are certain types of statement which, it won't surprise you, are super important. The one I'll just call out now is what's called no increase statements. If a bidder says, my offer is 100p a share and I will not increase it, then there is a sort of rule of thumb here that parties to an offer are held to what they say. So if you say my offer is final, no one made you make that decision, but we will say you are held to that, therefore you cannot increase it. So think carefully about, as a bidder, whether you make those sort of statements. It also won't come as any surprise that statements where parties to a transaction say they've got levels of support either for or against the offer are super important. And we say those statements must be underpinned by written verification from the relevant shareholders as to what their position is. Really important statements, that, because obviously that may influence what other shareholders decide to do. And a point I mentioned earlier, and I'll repeat it now, is and you may say this is so obvious, so why on earth are you making this point? But we think it's super important now that bidders are clear what their plans for the target company are. Once upon a time, you just had to state this information in the so-called offer document. This is now included in the announcement of a firm intention to make an offer. Bidders have to explain early on what their rationale for making the offer is, because we think this is a really important part of the dynamics of the debate about whether the takeover is a good thing for the company. And there's much more focus on this disclosure than there ever was. When I first arrived, I'm afraid this sort of disclosure was not as fulsome as it should be. We now are very focused on making sure that bidders are clear about what their intentions for the business are and what the ramifications for the target company will be, and that's super important. I don't need to spend much time on Rule 20. which is the rule that says that all shareholders must get same information at the same time in the same manner. I think I've largely covered that. I think it's obvious. I'm afraid we are a bit of a fun sponge about social media advertisements. Social media, we say, should only be used as an alert function for alerting shareholders to import the fact that an announcement may have been made or a document may have been published. We are not in the game of allowing people to make funny jokes on over Instagram or in advertisements. We once allowed that in the mid-1980s. The panel had to approve all the advertisements, and it was a very painful period. So it's been explained to me. I mentioned the import of no increase statements during an offer period. Think carefully before you make a profit forecast, because if you do, that may well need to be reported on by the company's advisors and reporting accountants. And indeed, profit forecasts that are published before a so-called offer period commences, the directors will need to confirm that that profit forecast remains valid. That's obviously, a profit forecast is an important piece of information, and that's why these extra safeguards apply. And there are also extra safeguards that apply in relation to asset valuations, in relation to companies that are asset-based. Again, there's the obligation is simply that the valuation must be reported on by an appropriate valuer. So these are important statements, so think carefully before you make them. Carrying on with the concept of big conduct once a so-called offer period commences, I mentioned earlier this point in relation to so-called General Principle 3, that is elaborated on in Rule 21 of the Takeover Code, and says that unless a company that is in receipt of an offer gets the approval of its shareholders in general meeting or otherwise gets the consent of the panel, it cannot take action which might frustrate the offer or indeed take certain specified actions, such as issuing shares, selling material assets, entering into or terminating a material contract. Why? Because taking that action may lead to the offeror no longer wanting to proceed with its offer, if that's a possible offer, or indeed wanting to lapse its firm offer. And we say that action should only be taken if it's approved by shareholders or there is a legitimate basis for allowing it to proceed. We may give our consent, we the panel may give our consent to that action taking place if the bidder consents to it, because then by definition it can't frustrate the offer, or if it's pursuant to a pre-existing obligation, or if it's in the ordinary course, or you've got 50% of shareholders who confirm that they approve it, because then of course shareholders are given their blessing to the matter. And there is a separate part of Rule 21 that deals with, restricts a bidder and a target company, even this is in the context of a friendly transaction, from entering into what are called offer-related arrangements. And this came in the aftermath of the Kraft-Cadbury transaction, this restriction, because we were concerned, and there was a concern across the market, about very, very bidders and target companies entering into what are called very detailed, what are called implementation agreements, where basically a deal was being locked up and it was not made, it was going to be made very difficult for a competing offer to be made. And we have basically said no to these types of arrangements, no to inducement fees, no to exclusivity arrangements, no to non-solicit arrangements. There are certain types of matters that are permitted, but they are specified in the relevant rule. I won't go through them now, but they are an exhaustive list. And the idea is that the target company, when it's in receipt of an offer from offeror 1, should be free to negotiate a competing offer with offeror 2 if that is what it wishes to do. And then finally, there's a separate rule in Rule 21, Rule 21.3, that says that information given by a target company to bidder A must be given to bidder B. That's not because we think we have a rule of equal treatment of offerors. It's more subtle than that. We say that it goes back to this anti-frustrating action general principle, that we say it shouldn't be permissible for a target company to prefer bidder 1 by giving it lots of juicy information, because bidder 1 is going, at the most extreme example, to give all the directors of the target company Ferraris and not give the same information to bidder 2, who is then impeded from revising or raising its offer. So it's an anti-frustrating action principle that we say information given by a target company to bidder A must be given equally to bidder B, excuse me. Rule 16 is a very simple rule that says that there shouldn't be any special deals done between an offeror and a particular target company shareholder. That won't come as any surprise, because I'm sure you've got the joke now that all shareholders should be treated equally. There will be certain situations where inevitably one shareholder might get a different deal. For example, if in a private equity bid where management are rolling over their shares into the bidding company, then by definition the management team are getting a different deal. But that is a function of there being management and this being an MBO transaction. But in those cases, there are additional safeguards that are applied. So I won't spend too much time on that. And sort of getting towards the end now, if, as opposed to looking at this through the lens of the target company, they're looking at this through the lens of an acquirer, there are a whole lot of important rules that you will need to take account of and think about. Just to call out some key ones here, if a bidder buys shares in the target company in the run up to the bid, then waving the flag that I've been doing already about equal treatment, it cannot be right, we say, that a bidder can buy shares in the market from, say, selected shareholders at 100p a share and then only make an offer at 80p per share. So what we say is that where a bidder buys shares in the market in the 3 months ahead of the bid, then the bid must be made on no less favourable terms. And that is, as I say, you heard me earlier, I'm not here to say that we know what price an offer must be made for a particular company. So when we have this provision that says if a bidder acquires shares at a particular price in the run up to the bid must be on no less favourable terms. That is just in recognition of our favourite general principle of equal treatment, not because we say that we know better as to how the particular offer must be priced. And this has further ramifications if you buy shares for cash. Then it may be that if you buy, depending on the number of shares you buy and when you buy them, you may have to make a cash offer available to all shareholders, even if you're thinking of offering paper. So think carefully about that. Rule 9 is a super important rule, and that is the so-called mandatory bid rule. And that provides that where a person takes his or its shareholding to 30% or more, it must make a mandatory offer for all the remaining shares in the company. And that is because we say that effective control of a company passes at the 30% level, and therefore shareholders in that company may no longer wish to be in a controlled company. And indeed, the potential controller may have paid a very high price in order to acquire control. And we say that high price should be made available to all shareholders, recognizing again our equal treatment general principle. So that's why you often see persons with shareholdings of 29.9% in the company, because that's the maximum that they can have without triggering this so-called mandatory bid obligation, where an offer must be made in cash. The mandatory bid obligation kicks in also if someone increases their holding in the 30% to 50% band, because obviously 30% is just a line in the sand. The actual control threshold for any particular company will vary from one company to another, and therefore someone may be on 32% and buying to 38%, because that's the person recognizes that that's the difference between it not having and having control of the company. And so those, in that circumstance, the two mischiefs I've identified earlier of giving shareholders an exit on control passing and also providing the premium price that may have been paid to all shareholders, making that available to all shareholders, those apply equally in this situation. Importantly, it would be all too easy to get around the rules if the rules just applied to the bidder or the individual shareholder. So there is a super important concept in the Takeover Code called acting in concert. And basically every rule that applies to an offeror or a person applies also to persons who are acting in concert with that entity. And acting in concert means people who cooperate together to acquire control of a company. It's a very simple concept. It's not a bad concept. If people are acting in concert, please don't think we think bad of them. It's just a concept that we have to make our rule book work. And there are certain categories of persons who are effectively presumed to be acting in concert. Family members are presumed to be acting in concert with each other. Group companies determined by reference to a holding of 30% or more of the votes are presumed to be acting in concert with each other. It's not a nefarious concept. It's just a concept we have to make our rule book work. There are detailed provisions in the rule book about how that all operates, and advisors can advise you on how those work. I just mentioned that it's important that if someone is planning an offer, for example, they need to work out who their concert parties are to make sure that those parties don't deal, because that could trigger an obligation under Rule 6 or 11 that I've just called out. Again, if you're thinking of going to 29.9% of a company's shares, it's super important that you make sure that none of your concert parties have bought shares, because if you have, then that will take you through 30% and you'll be in a whole lot of pain of at least being under an obligation to make a mandatory offer when that's not your intention. So it's a super important concept. I've gone very fast and probably too fast, and apologies for that, and I hope you're all still with me. I said it earlier and I'll say it again. The golden rule, I hope, with the takeover code is, if anyone has any doubt about how the rules should be applied, then they should consult with their advisors, and their advisors should consult with us. We actively encourage people to talk to us, and that's the way that system has operated for a great many years, and I hope it will continue to do so in the future. Thank you very much,
Charlie. Thank you so much. That was a great overview of how you're operating, how you have operated, and continue to do so. I've got a couple of points. If anybody else on the webinar has questions for Charlie, now is the time. Can you just talk about the current market? I think it's been quite a brisk time for the panel, and I wonder, you say there's always someone there to answer the phone. How do you? But no, I'm just interested really. How do you flex that capability?
That's a damn good question. So how's the market at the moment?
Yeah.
Oh my God, the summer was busy. I mean, it was, frankly, I went on a little holiday and I spent every single day of my holiday, morning and afternoon, on the phone. Sorry, you probably didn't want to know that or need to know that, but it was busy. And we're a very small organization, and therefore it doesn't take much to move the needle from sort of, everything's fine to panic stations. And there was just a lot going on over the summer, but there we go. It's a bit quieter now. But there are, not my expertise, but I'm told that UK PLC is still cheap, and therefore there are a lot of interested parties. Private equity. Once upon a time, we were told that private equity was never going to make another bid because we required bidders to be identified in a leak announcement. Well, I know a lot of time and water has passed under the bridge since then, but private equity is very interested in UK PLC. I think about a third of the transactions we see are private equity transactions. So they are very much a force to be reckoned with. Yeah, I mean, listen, we take calls, literally any time of day or night. I hope people will behave responsibly in so doing. But I have taken calls at 2 o'clock in the morning. Not the best fun. But we, if we have a mantra, which is we encourage people to speak to us if they have any doubt, it's incumbent on us to take the call and behave responsibly. So that's why we do what we do.
Yeah, and I think you inferred that, well, maybe I inferred from it that sometimes this great volume of the smaller transactions can be more challenging than some of the big ones, and you pointed to the importance of having advisors and so on. Is the main kind of point of contention around possible versus firm offer? That seemed to be an area that people really have to be mindful of.
Yeah, let me sort of take that back at the stage. I think the reason I encourage appointing advisors or speaking to advisors is just because if something goes wrong, it's very hard to put it right. Putting the toothpaste back in the tube can be very difficult, very challenging, and it's much better if people don't get themselves into that position. So I'm not here making this point to say jobs for the boys and jobs for QCA advisors. It's just it all works better if people comply with the rules, because if things go wrong, it's a whole lot of pain in trying to put it right. I banged on at some length about this concept and approach just because that is when obligations kick in, and I think it's quite understandable that sometimes people don't realise the obligations that apply from the time an approach is made. So that's why I've laboured that point as much as I've had. I think this notion of making an announcement where there's a leak. Once upon a time, and I hope I'm not offending anyone by saying this, once upon a time, I think advisors were a little bit cavalier about complying with that rule.
Right.
We've now published a lengthy practice statement some years ago on this subject. I think advisors take this very, very seriously now. Please don't misunderstand me. I think they take it very, very seriously. I think where it can go wrong now is actually at the company level, And that's not because the companies have been cavalier. The companies just don't necessarily understand the import of what's going on in our world, and that's why I've laboured the point I have. So I hope that answers your question.
And just finally, for me, obviously, when you talked about the lengthening rule book, but aside from that, the rule book is changing and has changing. We know because we fed into it recently. You have consulted on changes around dual class share structures, IPOs and share buybacks. Is there anything in the broadest sense that would interest people who are on this call today, or do we have to wait to see what you come back with?
Yeah, thank you for raising that. So the FCA has made it easier for companies to list companies with two classes of share, and so this is particularly focused on founders having shares that give the founder enhanced votes for a particular period of time. Once upon a time, the UK market was very, focused on one share, one vote, and so these types of companies would not be encouraged. The way that the consultation paper is focused on classes of share where the enhanced voting rights evaporate when they're transferred to a third party. So that can lead to issues arising where, if a founder either transfers the shares to a third party, or the voting, the enhanced voting rights has a thing called a sunset clause where it ceases to apply over a particular time, then, as you'll have gathered, we're very focused on passing of control. That's determined by a person's voting rights. That can fluctuate because of an event that is outside a third-party shareholder's concern. So if I'm if I'm on 25% and I'm not a founder and I don't have these enhanced votes, but then the founder reaches his or its sunset period, then my level of voting rights could go up because of an action outside my control. And the question is, does that trigger a mandatory bid obligation, for example? Now is not the time to go through the detail of those rules. We have published a detailed consultation on that area. I think consultees were largely favourable of what we were trying to achieve. It's an interesting subject because it just shows how market practice develops, things change, and how, as a regulator, you have to try and move with the times. So, some of those rules are quite complicated, and I'm sorry about that. It's the way of the world. I say to people, when people say to me, which they often do, "Oh my God, the rule book's got complicated," I say, well, we're just trying to keep up with what you guys are doing in the market. So there we go.
Yeah, look, it was, it's good to be reminded. It's if you like, a living document, and certainly, we put that piece of work went through a number of our expert groups, and it was quite complicated and detailed and granular. So, it was good to be part of the debate. Right, and a question is just as well, because I've done mine. But this is from Alex. Given this is the QCA focused on AIM and Aquis, although I would say, Alex, we also have quite a number of main market members, is there an argument to be made that the code is a 444-page sledgehammer to crack a nut? Should there be a takeover code light for AIM and Aquis companies? And there's more to it than that, but that's the broad. I'll start with that, Charlie, and go through the rest.
I totally get it. I get the point that the rule book has become longer. I don't think we have different rules for small companies by comparison to large companies. As I said, we treat all transactions equally, so to speak. And if there is a rule, it is there because there is a particular mischief we seek to address or consequence we want to impose, and that should apply, I would say, whether the company is big or small. I do recognise, oh my God, I recognise this, that the rule book has got more complicated. And, I find myself, I sometimes find it hard to keep up with everything that's going on. What I would say, though, is we do encourage people to speak to us. So if you're ever in any doubt, you just give us a call, and we will try and help advisors along their way. So
I think, as you know, Charlie, the context there is against as Alex says, against the backdrop of a climate of regulators and government seeking to streamline regulation, and we know that the LSE are looking at that with their AIM discussion paper. Another thing, Alex suggests a panel practice statement on common derogations that may frequently be given for common circumstances.
Fair point. The trouble is, where do you stop? But very always happy to take a call. Is my simple answer to that.
Okay. I hope that addresses that. So from Cleo, in my experience, the panel is the most professional and responsive regulator in the UK. Is this a planted question? I don't know. Other than the availability at all times point, how does the panel achieve this, and what lessons can other UK regulators learn? A very good question.
Gosh, thank you. I mean, I really appreciate that. We, nobody's perfect, and I'm not saying that we get everything right all the time, but we try very hard not to be a computer says no organization. We try very hard to explain what we're doing. It's absolutely not my job to tell other people how they do it. I think someone said to me, Charlie, your job is made easier by the fact you regulate transactions rather than organizations. And I think there is an element of truth in that. And for example, we have these very, very detailed disclosure rules about dealings in the company's shares, but we're only regulating the 30 or so companies that are in an offer period at any one point in time. Other regulators, viz. The FCA, are dealing with every single listed company at all times, and that is just harder. We focus on a niche part of the market, and we're very, 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 very focused on what we do.
Yeah. Okay. Yeah, good answer. Look, I'm conscious we're just about out of time, and I think that was a great overview of anyone who joined late. It will all be there on YouTube very soon. Unless there's anything further, Charlie, I think we're there, and we would thank you for your time and thank you for your continued engagement.
And thank you for having me.
Well, that's the point. To call back Paul to wrap things up.
Fantastic. Thank you, James, Charlie. Thank you very much indeed. On behalf of the QCA, we'd like to thank you for attending today's presentation. That concludes today's session, and good afternoon to you all.